Ladies and gentlemen, your Asian analyst here. I need you to pause for a second and recall what happened yesterday. Remember Christmas morning. Remember when I powered up this recording device, crashed your festive meal, and informed you, cautioned you, that the marketplace was fractured. I warned you the tranquility was deceptive. I explained the depth had evaporated. I pointed out we were positioned in a chamber filled with fuel awaiting ignition. And critically, I predicted that when trading resumed on December 26th, the valuation wouldn't climb incrementally. I stated it would jump instantaneously. Now, examine your monitor. Observe what transpired. $75.14, that marked the peak. We settled approximately $74.50. We leaped upward nearly $4 during a single abbreviated festive trading period. This wasn't growth. This wasn't momentum. This was marketplace disruption. We didn't merely surpass the historic peak. We demolished it. We abandoned it far behind. Traders in London departed for lunch with silver at 72 and returned, discovering their complete bearish positions eliminated at 75. We cautioned you. We stated Ghost Week wasn't a period for relaxation. It was a period for endurance. And now, the survivors are those possessing actual metal. The casualties are those holding paper positions. I need to analyze precisely how this movement occurred, because it confirms everything we've been discussing for the previous month. Typically, when an instrument advances 5% daily, it develops in patterns. There's purchasing, then distribution. Purchasing, then distribution. It battles upward. But today was unique. I was monitoring the order depth at the opening. At 8:30 morning hours, a purchase instruction entered the platform. It wasn't particularly substantial, perhaps 500 agreements. In standard conditions, that shifts valuation 10 cents. But because of Ghost Week, because the experienced risk supervisors at JP Morgan are vacationing in Aspen and the instruction ledger was hollow, that instruction encountered emptiness. No distributors existed at 72.50. No distributors at 73. No distributors at 73.50. The matching system needed to scan upward to 74 just to locate the initial agreeable distributor. And instantly, the valuation jumped. It bypassed the cents. It shifted in dollars. This represents what we term a void. We've penetrated a territory where gravitational principles don't function because no atmosphere of depth exists to decelerate the valuation. And the concerning aspect, the purchasing wasn't even forceful. This wasn't compression yet. This was merely several hedge operations positioning for January. If minimal purchasing can transport the valuation to 75, what occurs on January 2nd when authentic purchasing commences? Today's movement confirms three particular things we've been emphasizing. First, the open sky hypothesis. We informed you that beyond 71, no barrier exists. Technical specialists adore drawing boundaries on displays. They adore stating resistance at 72.50. But today demonstrated those boundaries are fictional. Once we passed the previous peak, no trapped holders remained seeking to distribute. Everyone possessing silver maintains profit. So why distribute? The distributors initiated a work stoppage. And when distributors initiate work stoppages, valuation becomes vertical. Second, the rigid foundation. Recall the Asahi vault depletion? 1.4 million ounces vanished. That established a foundation. We observed several attempts to force valuation downward today. At 10 morning hours, a minor decline to 73.80 occurred. It persisted 3 minutes. The arbitrage automated systems observing the valuation in Shanghai at 83, which we'll examine in Section 2, intervened and purchased the decline immediately. You cannot collapse a marketplace lacking inventory. Third, the algorithm alarm. We informed you the automated systems would reverse orientation. For 10 years, the algorithms were configured to counter rallies. Today, we observe the reversal. As soon as 73 fractured, the momentum algorithms activated green. They began pursuing the valuation. They disregarded fundamental worth. They merely observed a fresh peak and executed purchasing. This is the divine algorithm we discussed, and it currently operates for us. I find it fascinating that financial broadcasting remains quiet tonight. CNBC discusses technology equities. Bloomberg discusses petroleum. Nobody addresses silver. Why? Because they lack explanation. They cannot clarify why a dormant mineral just established a fresh historic peak on a festive day. They cannot clarify why the dollar collapses while rates remain elevated. They cannot clarify why China compensates 83. They maintain silence because they're frightened. They comprehend they overlooked the opportunity. They comprehend they instructed their customers to evade precious minerals, and now their customers will terminate them. This quietness is optimistic. When broadcasting begins demanding, purchase silver, that's when we concern ourselves. But currently, they're in rejection, and rejection is the initial phase of a supercycle. But here's the critical understanding from today. This was merely day one. Ghost Week continues until January 2nd. We maintain 4 additional trading periods of this skeleton staff situation. And today we demonstrated the skeleton staff cannot manage the stress. They couldn't maintain 72. They couldn't maintain 73. They couldn't maintain 74. What occurs on Monday? What occurs when London traders awaken and comprehend they're bearish at 71 and the valuation is 75? They'll alarm cover. And what occurs if we receive another announcement from Venezuela? We're penetrating the acceleration stage. The shift from 20 to 30 consumed months. The shift from 70 to 75 consumed hours. The shift from 75 to 80 could consume minutes. I need to address psychology momentarily. I know some of you are examining your account total tonight and grinning. You generated substantial money today, and the attraction is to activate the distribution option. The attraction is to state, amazing, 75. That's incredible. I'll capture my profit and repurchase lower. Don't execute it. You're falling into the retail snare. Retail participants distribute the breakthrough. Institutional participants purchase the breakthrough. If you distribute at 75, you're surrendering your position precisely at the moment of maximum acceleration. You're distributing your access to the destination because the vehicle vibrated slightly during departure. Do you believe BY is distributing at 75? Do you believe the Chinese solar corporations are distributing? No, they're purchasing more because they comprehend what I comprehend. 75 is economical. In a reality where Shanghai compensates 83, 75 is a reduction. In a reality where the Fed reduces rates into inflation, 75 is a present. Speaking of Shanghai, we need to address the differential. You might assume that because silver advanced $3 today, the separation with China narrowed. You might assume the arbitrage is functioning. You are incorrect. While we were celebrating 75, Shanghai just relocated the targets. We possess fresh information from the overnight period in China, and the valuation they're exchanging currently makes 75 appear like a mockery. And if you assume 75 is the maximum, you're examining the incorrect chart. You're examining a localized distortion in New York. While the authentic marketplace, the actual marketplace that genuinely consumes this mineral, has already relocated to a completely different territory. While we were celebrating a $4 shift here domestically, the Shanghai futures platform was operational for its overnight period. And what transpired there makes our rally appear like a calculation mistake. We possess recent information emerging from China currently. And the figures are staggering. The front-month silver agreement in Shanghai just reached a peak of 18,656 Win per kilogram. I need you to truly absorb that figure. 18,656. If we extract the calculator and execute the transformation at the present exchange valuation of approximately 7.0 to the dollar, and then partition by the 32.15 ounces in a kilogram, we aren't observing 75 anymore. We're observing 83. $83. Execute the calculation with me. The United States marketplace settled at $74.50. The Chinese marketplace is exchanging at $83. That's an $8.50 premium. Yesterday, we were emphasizing a $9 separation when valuations were reduced. Today, the valuation in New York jumped $4. And yet, the separation didn't narrow. The separation simply relocated higher. China observed our rally, responded with amusement, and offered the valuation upward even further. This is the definition of a fractured marketplace. In a functioning global economy, arbitrage is intended to be immediate. If an instrument is $8 more economical in New York than in Shanghai, every banking institution, every hedge operation, every algorithm on the planet should be purchasing in New York and distributing in Shanghai until those valuations converge in the center. That's how efficient marketplaces function. It's costless money. It's a risk-free exchange. But the separation isn't narrowing. It's continuing. It's expanding. And that communicates something alarming about the condition of the global supply network. It communicates that the arbitrage mechanism, the very adhesive that maintains the global financial platform together, has fractured. It communicates that the banking institutions cannot transport the mineral. They can exchange the paper agreements in New York throughout the day. They can exchange digits on a monitor, but they physically cannot obtain the 1,000-ounce bars, position them on aircraft, and deliver them to a storage facility in Shanghai to capture that $8 profit. The logistics have collapsed. The inventory has vanished. And we're witnessing the separation of the paper valuation and the actual valuation in real time. This $83 valuation in China is the phantom of Christmas future for the American marketplace. It's demonstrating us precisely where we're heading. New York is the delayed indicator. Shanghai is the advancing indicator. China is the purchaser of final option. And currently, they're alarm purchasing. You must comprehend this isn't speculation over there. This isn't some retail participant on Reddit attempting to compress a bearish position. This is industrial survival. The entities offering silver upward to 83 are solar panel producers in Jiangsu. Their battery operations in Shenzhen, they're the industrial core of the planet's second largest economy, and they're frightened. They're examining their inventory quantities for 2026. They're examining the plateauing mine production, and they're comprehending that if they don't obtain the mineral now at any valuation, their production lines halt. An industrial purchaser is valuation inelastic. That indicates they don't concern themselves if the valuation increases. If you're constructing a $50,000 electric automobile and it requires $80 of silver, you compensate the $80. If silver advances to 100, you compensate the 100. It adds $20 to the vehicle cost. It's a calculation mistake for the final product, but it's existential for the production process. You cannot construct the automobile without it. So when you observe Shanghai exchanging at 83, you're observing the authentic foundation of the marketplace. That's the valuation where the authentic actual demand is resolving. Anything below that is just a paper fantasy. And this establishes a massive irresistible attraction for the New York valuation. Consider the depth vacuum we discussed. We're in Ghost Week. The capacity is minimal. No distributors exist. And suspended over the marketplace is this massive $8 arbitrage motivation. Every algorithm still operating observes this. The high-frequency exchanging automated systems, the arbitrage automated systems, they're all examining the differential. Their programming is demanding, purchase New York, distribute Shanghai. Even if they cannot physically transport the mineral, the purchasing stress in New York functions as a reflexive response. The New York valuation must increase to encounter the Shanghai valuation because eventually, if the differential becomes sufficiently substantial, someone will locate the mineral to transport. Someone will deplete the final remaining ounce from the vaults and transport it to China. This is why the rally today was so aggressive, and it's why this shift is just commencing. We're executing catch-up. New York is desperately attempting to narrow the differential. But every time we rally, China rallies more forcefully. It's a reaction sequence. China offers it upward to obtain inventory. The differential expands. New York rallies to narrow the differential, which confirms the elevated valuation, causing China to alarm purchase even more. It's a destruction sequence for the bearish positions and a propulsion vehicle for the optimistic positions. And let's address who's captured on the incorrect orientation of this 83 reality. The precious metal banking institutions in London and New York are bearish. They distributed paper commitments. They distributed agreements at 68, at 70, at 72. Now the valuation is 75, and the authentic valuation is 83. They're submerged on billions of dollars of theoretical exposure. And typically their approach would be to suppress the valuation. They would discharge massive quantities of paper bearish positions onto the marketplace to eliminate sentiment and activate a distribution. But they cannot execute that currently. Why? Because if they demolish the paper valuation in New York downward to 70 while China is at 83, they just make the arbitrage differential 13. They just make the motivation to deplete the vaults even stronger. If they reduce the valuation artificially, they're practically compensating people to arrive and extract their actual inventory away. They're captured. They cannot suppress the valuation without forfeiting their actual reserves, and they cannot permit the valuation to increase without forfeiting on their bearish positions. They're checkmated. The sole escape is to permit the valuation to increase, surrender, and attempt to reverse optimistic before the remaining planet comprehends it. This is why I state the $100 surge is inevitable. It's not just enthusiasm, it's simple mathematics. The equilibrium valuation must be elevated than the 83 currently exchanging in China because China remains net deficient of mineral. They're still importing. If the valuation was truly balanced, the movement would halt, but the movement is accelerating. We're observing information that imports into China via Hong Kong are escalating again. They're extracting the planet dry of silver. And you must examine the currency aspect of this Shanghai valuation. The yuan is declining slightly against the dollar, yes, but not sufficiently to clarify this separation. This is a pure mineral revaluation. It's the East stating, we don't trust your paper derivatives. We desire the mineral, and they're positioning a premium on immediate delivery. That's the critical phrase, immediate delivery. The Shanghai valuation is for mineral now. The New York valuation is for a commitment of mineral later. The differential between the two is the risk premium of the Western financial platform collapsing. The marketplace is valuating a failure. It's valuating the probability that if you purchase a futures agreement, you might not receive your silver. That risk is valued at $8 per ounce currently. Next week, it might be valued at $10. So when you examine that 75 display on your monitor, don't assume, amazing, it's costly. Assume it's exchanging at a 10% reduction to reality. You're receiving a discount sale on a strategic instrument that's depleting. The marketplace is providing you a window, a brief moment in time where the paper manipulation hasn't quite synchronized to the actual desperation. But that window is narrowing rapidly. The instantaneous transportation we observed today was the marketplace lurching toward equivalence. It was the initial step, but we maintain $8 additional to advance just to reach equivalence with China. And do you assume China is going to remain stationary? No. As soon as New York reaches 80, China will be at 90. This is the characteristic of a super compression. It's a competition to the summit. And in a competition like this, The soul-defeating approach is to be on the periphery or worse, wagering against it. The ghost week, minimal depth is functioning as an accelerant. It's like discharging fuel on a combustion that was already consuming out of regulation. With no distributors in New York to absorb the purchasing, the valuation must jump in these massive increments just to locate depth. And the attraction pulling it upward is that massive illuminated advertisement in Shanghai that states, "We compensate 83." Every participant on the planet observes it, every algorithm observes it, and commencing Monday, when more operations activate, every institutional capital supervisor is going to observe it. They're going to observe that they overlooked the initial phase. They're going to observe the inconsistency. And they're going to alarm an anxiety of overlooking opportunity. Anxiety of overlooking opportunity is a powerful force in retail, but it's even more powerful in institutional money when they are underallocated to the optimal performing instrument category of the year. They must pursue. They possess no alternative. So the 83 target is not a forecast for next year. It's a reality for today in the dominant actual marketplace. It's a target for next week in the paper marketplace. We're monitoring the convergence, and the aggression of that convergence is what we observe today. But if you assume that was intense, wait until we address the catalyst that genuinely ignited the spark this morning. Because it wasn't just mathematics. It wasn't just arbitrage. There was a particular event, a physical event involving the United States military that transformed the algorithms from purchase to alarm purchase. The geopolitical temperature didn't just increase, it exceeded boiling. While we were concentrated on the valuation, the U.S. Coast Guard was occupied escalating a situation in the Caribbean that has global superpowers on elevated caution. This is the physical spark I cautioned you about. The mathematics provides the fuel, but the conflict provides the combustion. And what transpired off the coastline of Venezuela this morning is the category of announcement that transmits safe sanctuary instruments vertical. It transforms the calculation from profit to protection. And when money commences relocating for protection, valuation targets become irrelevant. You need to comprehend the particulars of this incident because it's the primary operator for the algorithm's behavior currently. It's the reason the dollar is being discharged and silver is being accumulated. This isn't just about supply networks anymore, it's about sovereignty. It's about a restriction that's transforming into a confrontation. And silver, the ultimate conflict mineral, the ultimate non-sovereign preservation of worth, is the sole location remaining to conceal. Let's investigate the particular incident that transpired with the tanker, because the mainstream broadcasting is minimizing it. But the shipping registers and the naval intelligence reports are illustrating a picture of a conflict that's spiraling out of regulation. This is the spark that ignited the combustion on the 75 propulsion, and it's still consuming. Mathematics provides the fuel, but you still need a spark to ignite the combustion. You need a catalyst that forces the algorithms to cease calculating documents and commence alarming about survival. And this morning at 4:30 Eastern Time, that spark was activated. While you were resting, the United States military didn't just escalate the trade conflict, they transformed it into a combat conflict, or at minimum, a boarding conflict. We've been cautioning you for weeks that the situation in Venezuela was the unforeseen event nobody was monitoring. We informed you that the restrictions were transforming into a restriction. And today we received the confirmation that transmitted the safe sanctuary algorithms into excessive operation. I need to be very particular about what transpired because the mainstream financial broadcasting is concealing this narrative under festive, superficial pieces about retail distributions and festive rallies. Early this morning, U.S. Coast Guard Special Operations teams, supported by naval instruments, forcibly boarded a crude petroleum tanker, designated the vessel in international waters off the coastline of Venezuela. This wasn't a documentation inspection. This wasn't a courteous request to observe the manifest. This was a physical operation. We possess reports of personnel descending from helicopters onto the platform. We possess reports of the staff being detained. Now, why does this concern? The vessel is not just some arbitrary boat floating in the Caribbean. It's a Panama registration vessel, yes, but it's possessed by a shipping conglomerate based in Hong Kong. It was transporting 1.8 million barrels of crude petroleum destined for China. Do you comprehend what just transpired? The United States military just obtained Chinese-possessed property in international waters. This is not a restriction. This is an act of conflict. This is a direct physical challenge to China's energy security and their sovereignty. For months, the White House has been utilizing the word embargo. But actions communicate louder than words. When you descend onto a vessel and obtain its cargo, that's a restriction. And the response from the East was immediate. Beijing issued a statement condemning the action as theft and a violation of sovereignty. Moscow cautioned that this reckless behavior threatens global shipping channels. But the most important response didn't originate from a diplomat or a press representative. It originated from the marketplace. You must comprehend how the modern financial platform functions. The high-frequency exchanging algorithms that operate the futures marketplace scan information announcements in microseconds. They don't peruse articles, they search for keywords. They search for sentiment. When the information channel is transmitted, U.S. Coast Guard boards tanker, and China condemns and restriction in the same microsecond, the algorithms switched from risk favorable to conflict configuration. In conflict configuration, the logic is simple. Distribute the currency of the aggressor, distribute the obligation of the aggressor. Purchase the instrument that possesses no counterparty risk. That instrument is silver. Typically, gold is the primary safe sanctuary. And gold rallied today, too. But silver exceeded performance. Why? Because silver is a strategic material. In a restriction scenario, supply networks fracture. If vessels cease relocating, commodities cease relocating. Gold is money, but silver is money, plus industry, plus conflict technology. It's utilized in the cruise missiles. It's utilized in the guidance platforms of the helicopters that boarded the vessel. It's utilized in the satellites tracking the fleet. The marketplace comprehended today that a restriction in the Caribbean doesn't just halt petroleum, it halts everything. It freezes the global logistics network. And recall the logistics fracture we discussed earlier? The marketplace is already frightened that it cannot transport silver from London to Shanghai. Now you possess the U.S. Navy boarding vessels. Who is going to guarantee a cargo of silver traveling over the Atlantic currently? The risk premium on relocating actual mineral just escalated dramatically. That's why the differential between paper and actual expanded significantly. That's why the algorithms alarm purchased the futures, because they comprehend the actual mineral is effectively secured. If the US dollar is being weaponized to obtain vessels, then the US dollar is no longer a secure method for China to preserve its prosperity. If you're China, you observe your vessel getting obtained. Do you purchase more US Treasury obligations? Do you maintain your reserves in a currency that can be deactivated or utilized to finance the Navy that owns obtaining your petroleum? No. You discharge them and you purchase mineral. This incident confirms the acceleration of dollar abandonment, which is the ultimate long-term operator for silver valuations. And here's the concerning aspect. This incident with the vessel is not the conclusion. It's the commencement. We're ascending the escalation sequence. We possess reports of a Russian naval detachment relocating toward the Caribbean for joint exercises with Venezuela. What transpires next week? What transpires if a Russian destroyer positions itself between a U.S. Coast Guard cutter and a Venezuelan tanker? Every step upward that sequence forces the valuation of silver elevated. Step 1 was restrictions, and we observed silver at 30. Step 2 is a restriction, and we're observing silver at 75. Step 3 is physical conflict, and that's where you observe triple digits. The marketplace is valuating step 3. The intelligent money isn't waiting for the combat to commence. They're positioning now, and this returns us to the ghost week element. This announcement contacted the information on December the 26th, the most illiquid day of the year. If this transpired on a standard weekday, distributors would exist to absorb the impact. Commercial hedgers would exist distributing into the rally. But today, the distributors were absent, so when the conflict algorithms discharged their purchase instructions, they contacted emptiness. That's why we received the void. That's why we transported instantaneously to 75. The geopolitical anxiety collided with a depth void, and the result was a vertical revaluation. The banking institutions were powerless. Their algorithms are configured to administer risk. And when the risk parameter advances to infinity because of a geopolitical clash between superpowers, the algorithm withdraws depth. It removes the proposals. It retreats and permits the valuation to ascend. This is precisely what we cautioned about. The skeleton staff at the banking institution operations did not possess the authority to intervene in front of a conflict-operated rally. They just monitored it transpire. And let's examine deeper at the implications of this tanker obtaining for the insurance marketplaces. This is a tedious particular that retail participants overlook, but institutional money obsesses over it. When a state participant obtains a commercial vessel, the conflict risk insurance premiums for all shipping in that territory advance vertically. This increases the cost of transporting everything: petroleum, grain, and yes, minerals. It adds friction to the global supply network. It makes actual arbitrage even more costly. If it costs 20% more to transport silver from London to Shanghai because of conflict risk insurance, then the arbitrage separation between London and Shanghai must expand by another 20% to compensate. This confirms that the $8 differential we're observing is not just a temporary anomaly. It's the fresh cost of executing business in a fractured reality. The global village is consuming, and in its location, we're receiving a fragmented reality of restrictions and obtaining. In that reality, the sole thing that concerns is what you can maintain in your possession within your own borders. Paper commitments from a banking institution in New York indicate nothing if the vessel transporting the mineral gets boarded by the Coast Guard. So the physical spark has ignited the combustion. The explosion in valuation we observe today was the direct result of money escaping the platform of trust and penetrating the platform of reality. The US government fractured the trust by obtaining the vessel. The marketplace responded by obtaining the silver. This is a reaction sequence that doesn't conclude until the geopolitical tension resolves. And examining the chart, examining the communication emerging from Washington and Beijing, the tension is solely going to deteriorate. But there's another force functioning here, a force that possesses nothing to execute with conflict and everything to execute with physics. We need to address what transpires when an instrument fractures its historic peak in emptiness. We need to address the structural mechanics of the display itself, because once you eliminate the final boundary of defense, once you fracture the final resistance quantity that has maintained the valuation downward for decades, you penetrate a strange and volatile environment. Technically speaking, silver is now an open sky. In an open sky, the regulations of gravity cease functioning. No resistance exists. No history exists. No distributors exist searching to retrieve their money because everyone maintains profit. When you combine a physical geopolitical catalyst with a technical breakthrough into historic peaks, you receive a marketplace that doesn't just momentum, it accelerates. It shifts exponentially. It establishes emptiness of its own. The elevated it advances, the more purchasers it attracts and the fewer distributors remain. It becomes a singularity, and mathematically, it's genuinely easier for silver to advance from 75 to 100 than it was to advance from 70 to 75. We're penetrating the territory of zero resistance. But conflict is not the sole operator here. And while the geopolitical sparks are ascending in the Caribbean, there's a quieter, colder, and frankly more powerful force functioning on the displays themselves. It's a force that possesses nothing to execute with politics and everything to execute with the physics of marketplace structure. We need to address the technical reality of what transpires when an instrument fractures its historical maximum and penetrates the emptiness of space. We need to address the physics of open sky. Technically speaking, silver has just executed something it hasn't executed in 45 years. It has fractured out of the massive consolidation configuration that has defined it for 2 generations. By settling beyond 74.50 and contacting 75.14 today, silver has officially penetrated valuation discovery configuration. Now, you might hear specialists discharge that term around loosely, but I need to clarify precisely what it indicates for the algorithms that regulate 80% of the capacity. In a standard marketplace, valuation movement is a battle. It's a trench conflict. As the valuation shifts upward, it encounters resistance. Resistance is not just a boundary on a display, it's a memory of suffering. Resistance represents a valuation quantity where in the past, people purchased and got captured. If you purchase silver at 50 in 2011, you consume the next 14 years examining a deficit. You are a trapped holder. So when the valuation finally returns to 50, your psychological instinct is to distribute. You desire to retrieve your money. You desire to conclude the suffering. That distribution stress establishes resistance. It functions like gravity pulling the valuation backward downward. But examine the display today. Examine 75. Who's captured at 75? Nobody. Who's waiting to distribute at 76 to balance? Nobody. No trapped holders exist. No memory of suffering exists. Every single person, entity, or central banking institution that has ever purchased an ounce of silver in the history of the planet is currently positioned on a profit. When everyone is achieving victory, nobody desires to depart the table. This is what we term a distributor's work stoppage. The natural provision of silver that typically arrives onto the marketplace from frustrated investors simply vanishes. Why would you distribute an instrument that just fractured its historic peak and is penetrating a parabolic stage? You wouldn't. You maintain. And when the maintainers refuse to distribute and the forceful purchasers, operated by the conflict information, intervene, the provision curve advances vertical. This establishes an environment of zero resistance. It's mathematically easier for silver to shift from 75 to 100 than it was to shift from 70 to 75. The friction is vanished. The atmosphere is vanished. We're in the emptiness. And in emptiness, a feather descends as rapidly as a hammer. In this case, the valuation increases as rapidly as a propulsion vehicle because no air resistance exists to decelerate it downward. Now, let's examine how the high-frequency exchanging algorithms process this open sky information. For the previous decade, these automated systems were configured with average reversion approaches. Their logic was, if valuation is elevated, counter it because it will return to the average. They generated billions opposing the rallies. But today, at approximately 9 morning hours, those algorithms underwent a regime transformation. When an instrument fractures a multi-decade peak, the algorithm switches from average reversion to momentum progression following. The logic reverses. Instead of counter the peak, the command becomes purchase elevated, distribute more elevated. The automated system doesn't concern itself about worth. It doesn't concern itself that silver is historically costly in nominal terms. It solely concerns itself about the vector. It observes the angle of the ascent, it calculates the absence of resistance, and it accumulates. This is why we observed the valuation transport instantaneously today. We observed shifts where the valuation jumped 50 cents in a single transaction. That transpires because the algorithm scans the instruction ledger for distributors and locates emptiness. It must offer elevated and elevated just to locate depth. It establishes what we term steps. The valuation doesn't curve upward, it stair steps upward. 75, 77, 80. Each step establishes a fresh foundation because no overhead provision exists to eliminate it backward downward. We're also observing the early phases of a gamma compression in the options marketplace, which accelerates this open sky physics. Marketplace generators, the banking institutions who distribute options to speculators, are currently bearish gamma. That indicates they distributed purchasing options at strike valuations like 75 and 80. As the valuation propels through those quantities, the marketplace generators are forfeiting money. To protect their risk, they're contractually and mathematically forced to purchase futures. Consider that sequence. The valuation advances upward because of the conflict information. The marketplace generator distributes options. The valuation advances elevated into open sky. The marketplace generator alarms and purchases futures to protect. That purchasing forces the valuation even elevated, which forces them to purchase more futures. It's a forced reaction sequence that consumes itself. And in an open sky environment, no maximum exists to halt it. In 2011, a maximum existed because of the historic peak from 1980. Today, no maximum exists. The sole limitation is the collapse of the currency itself. And let's be honest about the currency. The open sky for silver is really just the collapse for the dollar. When we state silver is advancing to 100, we're really stating the dollar is forfeiting the capacity to purchase strategic instruments. The valuation of silver isn't transforming. The denominator is collapsing. The algorithm comprehends this. The AI exchanging automated systems that administer sovereign prosperity operations are commencing to correlate silver not with other commodities, but with digital currency and other debasement protections. This correlation transformation is critical. If silver commences exchanging like a digital instrument based on scarcity and network effect, rather than industrial provision and demand, the valuation models fracture completely. In a digital style enthusiasm, a 5 times or 10 times shift is standard. If silver captures even 10% of that digital precious metal premium, 100 is a conservative foundation case, not an extreme projection. So technically, the configuration we possess currently is the most explosive display configuration in the history of financial marketplaces. It's a grand supercycle breakthrough coupled with a provision impact and a depth emptiness. You literally cannot engineer a more optimistic scenario. If you requested an AI to design a display that advances to infinity, it would illustrate the silver display as it appears today, December 26th, 2025. But a danger exists here, and I need to be responsible. When you're in open sky, volatility cuts both orientations. We could observe voids to the downward orientation, too. If a massive distributor, state a central banking institution attempting to manipulate the valuation, discharges $1 billion of paper onto the marketplace, the valuation could decline $5 in a minute because the purchasing orientation instruction ledger is also minimal. These are termed eliminator movements. They're designed to eliminate over-leveraged retail participants. This is why we cautioned you about leverage. In open sky, the transportation is vertical, but it's aggressive. The elevator cable has been eliminated, and the propulsion boosters are activated. You don't desire to be maintaining a 20 times leveraged position when the propulsion vibrates. You desire to be maintaining the actual mineral or the unleveraged equity, positioned backward and permitting the physics of the marketplace execute the function for you. And recall what we observed today. This separation to 75 was achieved by the secondary team. It was achieved by junior participants and automated systems. The captains of capital, the individuals who regulate the trillions of dollars in pension operations and endowments, are not even at their operations. They're observing these cautions on their devices while they're on the ski slopes. They're observing silver contact historic peaks, and they're receiving anxiety of overlooking opportunity. They're comprehending that they're underweighted the optimal performing instrument of the decade. This returns us to the alarming comprehension of what transpires next week. If the marketplace can transport instantaneously $4 on the purchasing power of several algorithms and junior participants, what transpires when the superior quantity participants return? What transpires on January 2nd when the massive institutions and the banking institutions and the sovereign prosperity operations transform their terminals backward, activated, and decide they need to allocate 1% of their portfolio to silver? 1% of global administered instruments is more money than the complete worth of all the silver ever mined in human history. If they attempt to penetrate this marketplace and this emptiness with these physics, the valuation won't just step upward. It will separation by $10, $20 at a time. We're addressing an institutional alarm into a marketplace that is the dimension of a container compared to the ocean of depth they're returning. The skeleton staff ignited the combustion today. They demonstrated that the resistance has vanished. They demonstrated that the distribution stress is zero, but they didn't return the authentic capital. The authentic capital is positioned on the periphery, monitoring, waiting, and receiving more anxious